to this Investor Daily webcast. My name is Maya and I am the Managing Editor of Wealth Management here at Momentum Media. So today we'll be talking about the Australian commercial real estate debt market, which has witnessed remarkable growth, reaching an impressive $447 billion by June 2023. Non-bank lenders are now pivotal players with a $74 billion market share, are reshaping the landscape due to market dynamics and regulatory reforms, leading investors to seek alternative financing. So here to discuss this topic with us today, we have Andrew McVeigh, who is the Managing Partner at Remara. Welcome, Andrew.
Thank you.
We also have Tom Cranfield. He's the Director of Investment and Risk at Zagga. Welcome, Tom.
Thanks for having me.
And we have Nick Raphaely. He's the co-founder and co-chief executive at AltX. Welcome, Nick.
Nice to be here.
Thank you all for joining me today. So let's jump straight in because we do have an hour to get through this sort of a pretty huge topic. So, Tom, we're going to start with you, actually.
Sure.
So we, as I mentioned, have seen a pretty sort of large and significant surge in demand for CRE debt over the past several years, so both from borrowers and investors alike. Mm-hmm. What is fueling this growth, do you think?
Yeah, I think you touched on it in your introduction. You know, traditionally or historically speaking, the four major commercial banks had dominated the lending landscape for commercial real estate debt, or CRED as you acronym you pointed out. That changed, you know, in sort of timelining it roughly 7-8 years ago. I think that happened as a result of, you know, increased capital requirements under Basel III. There was royal commissions into wealth and other parts of the banking landscape. And I think fundamentally for them, and I'm not speaking on their behalf, these are just my observations, it's an intensive use of balance sheet products. So the capital requirements are extremely high. And I think that gave rise for an opportunity for the establishment of non-bank lenders. You know, private capital has always been around, but you've just seen the emergence of it. Basically stepping in to fill the gap. I think the dynamic that has driven the establishment of the marketplace and the sophistication is that as time has gone on, you've seen more capital come into the space at a corporate, institutional, offshore, private wealth, high net worth marketplace. So the investor side, for the amount of capital available, has risen to meet the size of the market that's been created from the vacuum of the banks pulling back. And I think for us, we've stepped in to that gap, and we're hoping to fill that for a long time to come.
Definitely. And Nick, the housing supply and demand imbalance that we've sort of specifically seen over the past few years has really helped drive growth in CRED as well. Do you want to sort of elaborate on that a little bit?
Yeah, absolutely. I think sort of to pick up on what Tom was saying, I think that due mainly to regulatory changes, the ability of the bank to fund the full demand landscape is very restricted. There's obviously a housing shortage and housing demand that needs to be met. And I think it's really opened up the opportunity for other sources of capital to be put to work to satisfy requirements of developers, borrowers, builders, etc. I mean, we often think about this, I guess, a bit more broadly and philosophically, and I might just use an analogy. So if you think about, say, transport, so 20 years ago, if you wanted to get from A to B, you would have ordered a taxi. You know, you dial the 1300, the taxi comes to your house, picks you up, you pay cash or credit card, and you're done. Today, taxis still exist, and you can still use that form of transportation. But what we also have is Uber. So what is Uber, right? Uber is a technology which has unlocked a whole wall of supply. So this is, you know, in many cases, drivers, you know, private people who want to supply transport to an industry who are always there, but they never knew how to tap in to meet a demand, which is also always there. And so today what you have is you still have taxis as the subset, but you've got a much bigger ecosystem. You've got your supply of drivers and your demand for drivers. So if you parlay that to real estate and to finance of real estate, so think about banks as your taxi industry, kind of, you know, the core bedrock traditional players in the industry. They still exist, they still satisfy a need, but I think what we've seen is pockets of capital on the supply side being unlocked to fund demand for capital and need for uses of capital on the other side, in complement to what the banks do. So we really think about the whole space in terms of sources and uses, right? You know, you have people who want capital, and are the banks going to supply it, or are other parties going to supply it? And they could be sovereign wealth funds, institutions, private capital, wealth management businesses, the whole array. I think what it really means is that it's much more choice for the consumer and much more opportunities for people to provide capital.
Definitely. I can see you nodding there, Andrew. Anything to add to what Nick had to say?
No. Look, I agree with Nick in terms of his observations. I think it's rational credit that is provided by kind of the non-banks. So there's a lot more capital needed to do these types of developments, and sometimes the banks aren't always the best source of that capital.
Yeah, I mean, if you just permit me an observation, we started our business in 2012, and as I like to describe it, the business was launched at a barbecue. So what happened? We were at a barbecue talking to a mate, and his situation was as follows. He had a unit, an investment unit worth $1 million. He had a tenant in there, unencumbered, so no debt on the unit. He had an operating business, and he needed working capital for his business. It was sort of September, October time, and he was looking for $400,000. He was importing, things to sell over Christmas, and kind of that December period was his sort of peak trading period. What he really needed was fast access to $400,000. So he had an unencumbered property at a low LVR. He had a good credit score. He was going to guarantee the loan. There was a tenant in there. He had a plan to sell the property, when the lease ended, sort of 12 to 15 months later anyway. So we were sort of chatting to him in 2012, and we're thinking, well, obviously, the bank would take this deal, right? It's, it'd be possible to lose money on this. And then kind of came, all the issues. Well, I can't speak to anybody, can't get a firm deadline, it doesn't fit their products, I haven't quite lodged my tax returns. And we were thinking, we hadn't come from a traditional lending background, but we were thinking, hear all of that, but you're not going to lose money on this, right? There's just so many, it just feels like a great investment, especially coming out of the GFC when people have lost money on so many esoteric and misunderstood investments. This felt like a very simple, straightforward way to deploy capital. And I kind of think about the growth of private real estate debt in Australia, and I think about our barbecue borrower, and it kind of like that was sort of feels to us a decade later like the start of the explosion of the industry. It's like, how does kind of sensible, rational capital, find ways to fund creditworthy deals? And people would say, well, if you don't go to the bank, you must be a problem borrower. We often think to the contrary. If price is your only requirement, you'd go to the bank. But in the case of the barbecue borrower, if you need speed and certainty, price becomes a secondary consideration.
Definitely. And Tom, given obviously we spoke a little bit about the housing shortage, and there's also been a sort of spate of recent builder insolvencies in Australia. Would you say that investing in new residential developments is still sort of considered a viable option?
I mean, for our business, we've seen 25 to 35% compound annual growth from the investment side. We've seen the amount of capital that the investors have put in continue to scale up, and so the support that's underlying the business has just continued to grow. So I think there's a clear demonstration of that. I mean, we don't really get involved in the mum and dad stuff with the bridging loans. We tend to stick to the investment grade style developers and demonstrated track record, big history. There's certainly things that happen within a marketplace, such as cash flow issues and builder insolvencies, and so it's very fundamental that you have a rigorous due diligence process, that you're able to understand the credit worthiness of what you're writing, and that process can be proven time and time again. Nothing will be flawless. Lending is probably more of an art form than a science at times. So we certainly are always trying to continue to take our learnings and use those. But as it relates to commercial real estate debt and coming in, you touched on the housing aspect of it. I mean, we've got a 12-year low on approvals. We've got migration at the highest level that it's ever come through. We've got a growing economy. History would say if you've got a growing population and a growing economy, that's a great place to go and invest in. So for us, we see the tailwinds in commercial real estate, which includes residential, for us, because we're doing multi-level residential and subdivisions. It's not like we're doing the mum and dad housing stuff. So we certainly see the tailwinds, we see the economic fundamentals growing it, and when we look at our business and when we look at the marketplace, you can see the amount of capital that's come in, and you can see that in Australia, you can see that globally. You can look at the largest asset managers in the world, and they've all been raising private credit funds. It's what you're reading about in the paper all the time. So I certainly think that everything that's needed for the market to continue to grow, for investors to continue to come in, and we've also touched on why the regulatory landscape suits it. So I don't see any any change, and I see it in a very positive manner.
That's good to hear. And Andrea, how do you sort of view what Tom spoke about, and especially sort of the recent insolvencies that we've seen across Australia? Are they hurting cred, would you say?
Well, I think they're certainly having an impact. Like I think to Tom's point, you see 12-year lows in terms of approvals. That's obviously going to have a fairly major impact. But the opportunity set for most builders and developers now, the biggest thing in terms of underwrite is understanding who the builder is, particularly as you start to go multi-storey. Having insolvencies through the builders and the service providers substantially increases the risk profile of those projects. So I think it's certainly something that we're considerably more aware of, and it's something that's come out of that we see across our platform, so not just in commercial real estate, but across all lending activities that we do. There was a period through COVID where the ATO provided a lot of leeway for people to not pay their BASs and their taxes when they were kind of due. And now what we've actually seen is the ATO start to really crack down and make everybody pay it back today. And I think that's driving a lot of the insolvency actions. What we've started to see is less insolvencies that are supply related or input related. So the rise of construction costs was obviously a very big thing through COVID. We're seeing less insolvencies as a relation to that, and more probably insolvencies that are probably more book insolvencies. So they're not necessarily having a lot of jobs on, but they're actually looking to deal with their company, put it into docker, do whatever arrangements they need to do. So in those types of scenarios where they're more book entries, they have less of an impact on supply. And less of an impact on the execution of projects, but there's still definitely cash flow shortages in there, and actions being taken by banks, ATO and whatnot is certainly draining liquidity from the system, and that will place pressure on those builders to be able to complete those projects.
Definitely.
I think I was just going to add one point, because Andrew made me think of it when he was talking about it, and I didn't bring it up before. With builders and their insolvency, something that I point out in some of the conversations I have is, with the housing shortfall and the amount of work that's there, when it happens, in the space with which our businesses all tend to operate in, they're privately owned companies, and because there's such a great need for the trades and the tradespeople, the redeployment factor to get those people from shutdown of a business or an administrative problem back into the property market is extremely quick. So whilst a business might have an individual issue, which is what sort of Andrew was touching on, doesn't affect the marketplace, because the marketplace is so demand orientated for labour, for more supplies, for sub-trades to be on those sites. So even though the insolvency rate might be up, it doesn't mean that that's an indicator that the property market or that the housing shortage is going to face the same issue as the underlying builder is facing. So
they're being absorbed right back into
I mean, I think maybe if I can just add to that, I think the one thing that we're seeing in relation to the projects is the impact of the successive interest rate rises over such a short period of time. I mean, you effectively saw a 400-point rate rise in, it might have been like a year and a half. And I think that flows through at every level, but certainly, people that would have been holding land and would have done feasibilities on in the pre-rate rise environment are now kind of looking at their projects in the current environment. And I think many of them still have their heads stuck in the old world, and they haven't kind of addressed the reality that, the project might not be viable, or, looking down, they might have overpaid for the land, or they might need to put in more equity to fund the project. Or, I guess getting the sales away at the end might be harder because your end borrowers need to, pay 6 to 7% instead of 2 to 3% for their debt. I think that feels like that is really starting to kind of play through on the developer side. And I think, Andrew made the point too. I think that the leniency that the tax office had during the COVID period has ended. I think, it's into collections now. So I think those two make for somewhat of a challenging environment. And I think when we look at the environment, the rate rises stopped, and then there was a period of 3 or 6 months, and I think people were early to call victory, say, that cliff everybody worried about hasn't happened and it doesn't exist. I think in reality what it feels like to us is people had buffers and savings, and the rate rises came to an end, but then people had the buffers, and it feels like now they're getting to the end of that, and now we everybody's kind of facing the reality of kind of what does this actually mean. I don't know if you guys kind of share that view or seeing similar.
No, we'd see exactly the same, because we go across multiple types of credit. We see SME borrowers, we see dealerships, floor plan finance, we see commercial real estate, the liquidity is certainly starting to be drained at a much more rapid pace than what it has previously. So I think we're coming into a period, so our house view is probably still no rate reductions for the course of 2024, but probably post-Christmas we're going to get some pretty poor economic data is our expectation, so probably first quarter 2025. And that will play out through the real estate market, but I think one of the benefits that we see is because of that lack of supply, there isn't a major shift in actual property values. So people are still very, very cautious. They're not coming in, they're not buying a lot of properties, but they're also not selling a lot of properties. And that's kind of keeping the market in a bit of an equilibrium.
Yep.
And Tom, speaking of sort of trends, what sort of trends are you seeing in respect to the competition between non-bank lenders and major banks in the cred space? We spoke a little bit about obviously the banks sort of leaving the space to an extent and then creating room for the cred space, and giving away that market share to the cred debt space. What are your thoughts in terms of that competition now? Where does it sit and how are the big banks sort of viewing the space, I guess?
Look, I think the large banks will always have a hand in the space. Property in Australia is just such a huge asset class. I think roughly speaking, just the total value of residential is 7 times the ASX 200 or something like that. So they're always going to have a marketplace within it and core clients, and particularly at the institutional level where we don't focus on that 100 mil plus space, but they will continue to operate in that space because they need to from a client retention and strategy point of view. But we don't see the challenge of it based on the covenant packages and the leverage packages which we offer. We have a very rigorous due diligence process on the application of every project that we take on from a project finance perspective. We do see that because we're lucky enough to have all of our borrowers, not all, but nearly all of our borrowers with a banking relationship or have been a bank client, that they might do a comparison between us and the bank. Usually speaking, it's then down to speed for certainty of capital. Nick touched on that certainty before. If you've got to run a pre-sales campaign, lock in those sales, if you have a view that the value of those properties are going to be worth more on completion, then cost becomes less of an outcome to that, because ultimately, these developers are looking at their bottom line, and if they're going to see that their bottom line after finance cost is improved and that they can go to their builder and they can have the certainty of locking in their capital, and that allows them to take their project forward, as opposed to that builder takes another job because you've got to go and get 6 pre-sales for the bank, and those 6 pre-sales could be 10 or 15% below where the end market is. So we do see some level of that because of the nature of the clients that we're dealing with. As it relates to the non-bank space itself, I guess the point there amongst the other participants in the room and the broader industry is that you've just seen a much greater prevalence of project financing and cred financing come into the market, because you've seen much more demand from an investor perspective, and the banks pull back to fill that gap. No one's quite got to the point of doing it. So I think each of the non-banks has probably increased the amount of capital that they're deploying. They've all gotten bigger. I think that's a trend that will continue. I think the banks will be there, but it will come down to, what are your terms, what are your covenant packages, what's the certainty that you can get your credit approvals with, and if you can offer that certainty of capital, good relationship, good package, covenant package, and good financing, then I think that the non-banks tend to now win out. That's my experience.
I had a question, perhaps I could ask Tom. In certain parts of the market, I'm thinking more in kind of the 30-year investment loan space, where you have like Bluestone, Pepper, Liberty, etc. The banks actually provide the funding, the warehouse funding for the non-banks to do the lending, which the banks either choose not to do or not equipped to do. So like, we don't want to face the customer, but we're comfortable to be the money, and we trust your systems, processes, origination, governance, etc. And credit settings, obviously, for you to go and then effectively lend our money with a slice of first loss in there. One hasn't seen, much, if any, of that in construction. In other words, kind of banks engaging with non-banks in construction, saying, we'll give you warehouse funding to do. Do you think that'll come? Do you think
it's an interesting question. Westpac New Zealand just did that, actually, with a separate market participant that they
in New Zealand.
In New Zealand. So they've done that. So that's now it's not in the Australian marketplace, but that's closer to home than where it's traditionally been done out of the US or Europe. Some of the warehouses that are available for leverage within a fund could be an answer for that. And I think that some of the institutional providers do have leverage. I don't know if it's from a major bank. It's obviously private information. I think it's a very valid conversation as to, will the banks do that? One thing I do know that they have done is in a number of the bank's private wealth divisions and private banking, they've now got the non-bank offering as part of their APIs and improved products. So their clients
on the wealth management side,
on the wealth management side. So we're seeing the commercial banks are exposing their clients to the managers who, to your point, have a track record and do well. We have now seen one of the major commercial banks, obviously in a different jurisdiction, but within the, Australasia, do a transaction. I don't know whether it's, I don't have the insight as to whether or not they're interested in doing it more and more so. I think maybe Andrew will be well placed outside of Cred. They have done it, and you have a deeper point, so maybe I can hand to you to speak about it, your views as well.
Look, I think it's always going to be challenging for that direct relationship with the bank for that type of warehouse structure on substantial obligor sizes. It kind of goes against what is traditional securitization. So I think you'll see it and there'll be the opportunity, but it will be more deal by deal, I think. And they'll want still a pen to kind of tick and tie that underwrite. I see that as probably a pathway that might occur, but it's hard to put $20, $30, $40 million loan into a securitized warehouse unless it's a very, very big warehouse.
Well, on the point of securitization, no major bank's ever successfully securitized construction. There's a US group that's trying to do it now, but no one's been able to do it because you just can't predict the cash flows accurately to make the underwriting. So if they're coming at it from a warehouse perspective as opposed to a securitization perspective, maybe that's possible. And the other thing is that, like in infrastructure, there are non-banks and banks who go into a club and do syndicates. So, maybe in the larger ticket size, there's an opportunity where they'll look at doing syndicates, and that way with the joint lead manager, you can do the underwrite and you can participate for a slice.
And that's similar to corporate loans and larger corporate leveraged buyout loans and things like that. So there's definitely precedent there for a structure. It just hasn't been applied. And I think a part of that is because you've got also a lot of pension funds, sovereign wealth funds that are now investing into the Australian cred market. So they're kind of sopping up a lot of that demand that the banks would potentially step in and fulfill. And their returns are pretty much priced the same as the banks.
I mean, on the banking side, and it's a slightly different point, but just staying to the points we've been talking about, this is just an observation. This isn't said with any insight of a investment committee conversation or an ALCO at a bank. But CBA is regarded as one of the best banks in the world. Their share price is at all-time highs, and they've pulled back from the cred space whilst they've had that ascendancy. And the same with the other banks. They've all been trading up. Their profits, NAB announced, I think it was 1.8 billion for the last quarter. They all seem to be making a lot more money. So one would wonder, what's going to drive executives to want to start deploying huge amounts of capital in a product that, with the way they are as deposit-taking institutions, is high cost of capital for them. You'd think, well, things are good for them. They're not really going to drive back into the space.
Well, my next question actually ties into that. I was going to ask you, Nick, how the big banks are currently responding to the rise of non-bank lenders in the cred space. I guess we sort of covered that a little bit.
It's a good question, though. I actually think we have competitors in what we do, and we have a range of products and different competitors in different product sets. We don't compete against the banks, so I don't regard the banks as specifically as, I don't believe, like a threat per se to the cred space. Whenever we talk to a borrower or a broker who's bringing a borrower, what I always try and encourage our team to get to quickly is like what's important to the borrower. And when you want money, it can be a range of things. And people often say price is important, and price can be important. So if price is your key factor, and you've got all the time in the world, and you've got all your docs lined up, and you're prepared to wait until the decision comes, and you fit the bank's products, you should be going to the bank. But if anything else, aside from price, is important to you, my ears always start to prick up because potentially we're in the game. So in my example of the barbecue, if it's speed and certainty, we can win, we can beat the bank. We won't beat the bank on price, but we'll beat them on those criteria. It might be flexibility, that might be the loan structured in a particular way. It might be, if we're doing a construction loan, access to decision makers to come into the boardroom and brainstorm, how we can get a structure to work which works for them. So all of those things, I think that the non-bank credit space can do in a way that the bank can't. So I always kind of think about the bank as occupying the middle of the highway, like where the most volume is, where the most vanilla traffic is, and more kind of where there are credit-worthy borrowers and strong deals which just need capital that thinks in a different way. That's where I think kind of the non-banks come into their own. And people have said to me, rates were low, now rates are high, property prices went up, now they might come down. Like, is this the end of the non-bank space, or what does it mean? And philosophically, in my view, and I could be wrong, but I kind of believe this, to my core, is as long as the bank, and this kind of gets back to kind of the Uber analogy, as long as there are creditworthy transactions which the bank can't fund, someone is going to step in and fund them and provide the capital on sensible terms with the right covenants, etc. It might be us, it might be our competitors, but I think that the industry will continue to be strong.
And elaborating on that, Andrew, what do sort of borrowers get from non-bank lenders that they can't get from their banks? What is it that gives that advantage to non-banks?
Well, I think both Nick and Tom have touched on it. It's certainty. It's knowing that you've got a pool of capital available to you, and it's also flexibility around that pool of capital. I think some of the challenges that we see at the moment is, as Tom pointed out, there's pre-sale levels, hurdles, requirements. There's certain structural requirements that banks need, and those are very prohibitive. If you've got a nice vanilla, clean project with pre-sales, and you've got your builder all lined up, and he's got a great balance sheet, a bank is going to be the cheapest cost of capital. But there are very few projects exactly like that, particularly as you get into the smaller scale projects of sub 30 million. You've got private individuals or private businesses that are doing that don't have the same levels of institutional governance that you see from some larger developers and things like that. And that's where the bank just can't be as nimble as any other non-bank provider. So some of the key things that we see, you've got valuations that have kind of stabilised, as we pointed out. With that, you then have pressures on value, capital, and everyone pegs the 65% LVR as kind of the key senior level. What we started to see now in probably the last 12 months is people needing a little bit more than that. So they might go previously 65, now it's 70, maybe 72. So capital requirements for developers are now changing based on the underlying market structure. Banks can't respond to that because they have hard set levels, and that's ingrained in all of the risk weightings and internal models. Non-bank sector is a lot more better
flexible
placed
that,
to be able to be flexible around that. And that can be multiple non-banks working as a pair. So doing a 65% loan and having a small mezz piece, doing it as a stretch senior, doing it as a unitranche, multi-tranche, bilateral, syndicated. There are many, many different ways now that the non-banks can actually provide that flexible capital. And it means that projects still can go on even when they are not looking exactly like the bank quality or what was bank quality and is bank quality. They still continue and can be made and can be built and can be developed out.
Definitely.
Just two things that the guys were making me think about while I was sitting and listening to them, and I agree with everything they said. But one thing is, just the market dynamics have significantly changed. Some of the questions probably, almost elicit a response as though there's a reluctance, right? But that was when the market was being established. That was when people didn't understand the credit space. They hadn't used the product set before, and as Nick said, there's fundamental reasons why people do. But today, we have over 30% of our business is repeat and direct to market. And that's people seeking us out to do business with it. There's absolutely no market dynamic now that's driven by reluctance. We find that in most instances, the conversations we're having are had with developers, with sponsors, with introducers before they've even spoken to the bank. And I'm sure that Nick and Andrew are facing that same thing. The borrower marketplace has completely understood and learned and utilised the market for their benefit. They're taking our money that we're giving them for projects to make money. And so they see it in a very favourable lens, and having the certainty, the understanding, having had the experience. Now that time has evolved and the market has established and people are going for their second, third, fourth iteration of borrowing, it's not that there's any reluctance or that there's hesitation. It's completely gone now. Everyone understands how it works. And the other thing to add with respect to how you're funding and what happens between us and a bank, I mean, the bank is one of our greatest friends. That whilst they maybe aren't wanting to fund every type of project anymore, they still love stabilised income producing assets.
Yeah.
So for us, like when we're funding industrial, commercial, we've got shopping centres that we're doing all of that. So, you know, effectively from point A to B, where they're not, but at B, they're there. So, you know, we're establishing the construction piece based on a future ICR, a future LVR, a whale, a pre-leasing commitment, and the bank is coming in and they're one of the biggest refinanciers of all of our assets, which are holds and construction for our clients, and that's why a lot of our clients still have this bank and non-bank, and so it's a very dynamic marketplace. It's generally a very friendly one, but it's not one that's driven by the reluctance that was there years ago.
Yeah.
So I would agree with that. I would think, you know, possibly in the early days, the space or the lenders might have been looked as lenders of last resort. I think, to Tom's point, you know, in the space in which we operate, we're lenders of first resort today. And, you know, that speaks to kind of the repeat business that you get from people who see value in what you do. Just kind of sitting here in North Sydney, kind of thinking about the analogy, if you wanted to go to the city, right, you could jump on a bus, it would be cheap and it would take longer, but you'd get there, or you could jump in a taxi and you get there faster. You know, which is the right thing to do. Probably more people would take a taxi, actually. You just got to get there. So the taxi is non-bank, right? The bus is the bank. Is the one smarter or dumber than the other? Is the one right or wrong? No, that both make sense. Just depends on what your objectives are.
Yeah.
People tend to get funny because it's money, but in reality, you see it in every facet of life every day. People will pay for what's important to them, and you see that in the real estate, you know, lending space too.
Definitely. So, Tom, no sunset date for non-bank lenders then?
No, I certainly don't see it. I mean, you know, Australia as a percentage of its marketplace was obviously very small post-GFC. There was a market before that point in time. But when you look at the global landscape, the US, their commercial real estate market outside of their banks is close to 50% of their marketplace. Europe and the UK, you know, it's north of 30%, and ours is growing every week, every month, every year. And as we've touched on for various reasons, we don't see any change coming, you know, whether perhaps APRA or ASIC wants to get more involved from a regulatory space. You know, there's a conversation around some of that. There's been some noise, but I certainly don't think that there's a sunset date to what's happening, because you can see the support of the marketplace at every level. As we touched on at the outset, you're seeing offshore money at an institutional level, corporate money, family office money, private wealth money, very smart, very rational money that wants to deploy for what the products that we're able to offer on the borrower side back to them, and you're not seeing the banks want to come in. I mean, further, the other piece is that, well, I've touched on, you know, our clients are taking out capital to make money with that money. If the bank is at 50 and we're at 65, you know, one of the conversations for the developers that we're having is the realisation that they value their equity at a very high return. They value that return more than they value the cost of the debt. So I touched on at the bottom line making more money before. If they can borrow 60-65 as opposed to 50-55, then the equity return by taking that money and using it for a second project, or if the two projects become three projects, the scale and then the fact that they're profiting off it, they're not even looking at it at times where that it's a cost factor. They're actually seeing that it's a profit factor. I mean, we just done a transaction with a client that's never not been at a major bank for 20 years as a developer, and it came down to the concept of pre-sales. The people who bought in his previous project basically sold those apartments on completion for almost the same profit as he made, and he only sold them to meet the bank's covenant package. So now he looks at the cost of the capital, and then he looks at what the bottom line will be after the project's completed and what his expectation of future value is, and he's going to make far more profit. So it's not always, you know, cost is just an explanation, and I think, to the thing I was saying before, that's now understood across the market.
Yeah. And Nick, how do credit lenders sort of mitigate the risk associated with potential declines in property values and commercial property values in particular, as has been observed in the US market recently?
No, look, I think commercial is a very tricky sector at the moment. I think, as is widely understood, you know, commercial property values respond to interest rate changes with a high degree of sensitivity because they're valued based on a cap rate. And so the sharp and almost unprecedented rise that we saw in interest rates from, effectively from rock bottom to I think 4.35%, I think that quickly and very directly impacted the value of commercial property. So I think with my lending hat on, we're very circumspect, and it forms just a very small part of our book. I think it's a combination of kind of where we hunt and what comes to us and what appeals to us. But certainly we're very, very cautious when it comes to that, just because values have moved so sharply. And I think it takes time for things to adjust, because people hold on to assets, whether they're held through a listed fund, whether they're privately held. You don't want to sell to crystallize a loss. So it's kind of like, how long can I hold on for, and how long can I justify value for before I kind of face the music, get the sell done, and then perhaps becomes a comp for the rest of the market. So I think you're kind of seeing a lot of people holding off right now, is sort of what it feels like. And then I think also within commercial more generally, I think that this whole kind of rise in technology, move to kind of work from home, probably for the first time, in generations, you're seeing like a slowdown of people coming into the CBD, and that obviously has its biggest impact on B-grade buildings. I think people can almost get A-grade leases at B-grade prices today, but what is the future of the B-grade building, like in a city or a city fringe? I think that's a real source of concern. And you've seen in places like San Francisco and the like, like properties transacting for like fractions of what they would have been worth, in 2016, 17, 18, and it's quite confronting actually, because in Australia you always think safe as houses, everything always goes up, and I almost think kind of post GFC, really from 2012 onwards, when rates started going down, no one lost money on anything pretty much for a decade. Yeah. It's like the only thing you have to do is invest in something. Pretty much everything that the stock market, rent out property. The biggest mistake you could have made was just to be in cash, and people forgot what risk was. And I think that that's changed in the past 12 to 18 months, and commercial property at the pointy end. I'd be interested to hear what the other guys have to say about that.
And an audience question has actually come in about the outlook for the office sector. So if anyone wants to add anything to that as well, Tom. I see you smiling.
Look, I think Nick's finger's right on the pulse. I agree with everything that he said. I think there is a divergence or a difference between the US and Australia in respect of Part 10A bankruptcy, the ability to hand back buildings, the way the guarantee system works, and our corporate insolvency laws are very, very strong, and they're secured creditor friendly. So, I certainly agree with the fundamentals that they align. I think maybe there's a slight difference here that does benefit us in this jurisdiction. Commercial real estate, the outlook for mine, again, I'm going to use the word certainty. I think that right now, to Nick's point, you've had that rapid escalation in interest rates. When there's uncertainty, it's harder to do things. I think that there's still a growing economy, there's still a growing population base. I think that, you are seeing multi-speed outcomes such as B-grade buildings and C-grade buildings, so location aspects, sizing becomes more important for all of us. I'm sure we all apply the lens that we're trying to select the right ones in respect to design and location and aspects and all of that kind of stuff. I think as people become more confident that there's a stabilisation of rates, as they become more confident that incentives are trending down, because right now the net face rent might look good, but if you're paying for the fit out or you're not receiving any actual rent on what's supposed to be a cash producing asset, it increases your uncertainty. So I think the outlook, not trying to answer the question, is still uncertain, but I think what will change that is when people feel the certainty of incentives trending down, businesses growing, and interest rates being stable. They don't necessarily have to drop, but they have to believe that they'll be at a point where they can make their decisions, and then fundamentally the economics take over of the need for space. I mean, the vacancy rate for industrial in Sydney is like 1%. So it's not like there's not an underlying demand or need.
That's industrial, is it?
That's industrial.
That's pretty.
I think I'd just add to that. I think one of the things that you'll probably see is repositioning of assets. So office assets being repositioned into potentially resi assets. So highest and best will start to come into it, where you've got lower rents, you've got more capex required to keep that office or change it from a C grade to a B grade. The opportunity set then to reposition that as a residential asset because of the housing supply shortage starts to come into it, and that will defend values to a certain point, but I still think we're probably a little bit away from that.
And staying on commercial property.
So just on Tom's point, I think the certainty is a key thing. I mean, I think I think the whole market had broadly expected no rate rise until 2024.
Well,
and
that's what
everybody's
we're told,
everybody's completely blindsided. So
Yeah.
it's kind of like, well, what next? And like maybe I should just sit tight for a while and do nothing.
And now we're being told no rate cuts until next year.
So I
potentially.
think Tom makes a good point. I think things just need to settle down. Decisions can be made when there's a level of certainty and predictability, and you've got some visibility. Having said that, some of the best investment decisions are made at times of uncertainty, right? If you're prepared to take a view and you can kind of look through the mist and kind of see to a time and a place when everything has settled down, sometimes you can do well. So I guess there'd be different ways to approach it.
One thing that probably, speaking for the benefit of all of us, whilst we're certainly happy to give all of our views and what we read and know about commercial real estate, majority of our businesses are not geared. Nick talked about B-grade office buildings. That we're not, as I don't believe Remara or Assetline do, taking positions on B-grade office buildings. We're not in that sector. For our investors' benefit, the defensive nature of the investments we're making, most of our businesses, I imagine, would be predominantly exposed to residential real estate being the deepest marketplace, although we're doing commercial real estate lending. It's not that we're, in fringe office towers with 40% vacancies. We're not exposed to that.
You'd hope
for our
so,
investors or our businesses. Yes.
Well, that's what I was actually going to ask, how sort of lenders and investors sensitise their strategies, I guess, to market movements and to what's happening in commercial property. But I guess, Tom, sort of, if you want to elaborate on that as well.
Yeah, look, I think Tom stole my thunder.
Yeah, he did.
but I think for us, like we're always looking at what the underlying liquidity is in the market, what not only in terms of resi as a subsector, but within that, is it residential subdivisions? Is it unit blocks? Is it townhouses? Is it duplexes? Is it high-end luxury? Is it mid-tier first homes? What are the areas and pockets of liquidity? Who's hurting the most? What areas should we be focusing on to ensure that we've got the biggest underlying buyer universe for that end product? So, all of our aspect that we go through and all of our underwrite criteria is predicated on states, project types, builder types, price points, and understanding all of those dynamics. What's the net absorption of people moving into a certain area? How much demand is going to be in that area? How much demand is going to stay in that area? What are the other projects being developed within that could take some of that demand? Because all of those are factors in terms of ensuring that you're lending to the right projects. In terms of commercial office, we don't do commercial office. We don't have exposure to that. We've been pretty bearish now for ever since the rate rises started to occur. I think there will be points in time where it will start to make more of a rational investment decision and decision for us to be able to potentially lend against those assets, but it's certainly not something that we see at this point.
Okay. And this is one for all of you, but we might start with you, Nick. Turning sort of to investors that are considering cred, what is it that they need to sort of consider when assessing risk, I guess, and returns for cred in their portfolios to achieve stable returns?
I think it's never been a better time to be an investor in the space, and I think there's probably two main reasons, in my opinion, for that. The first is after a decade, you have businesses with track records. So if I think back to kind of how we funded our barbecue loan way back in 2012, like if we were looking to raise 200 grand because we were putting in half, we had to explain, first of all, who are you guys? Like we kind of think we sort of know you because we might have known you from before. Yeah. So sort of tick there, we can get ourselves comfortable, but kind of what is this? Like I've never heard of this private real estate debt. It's like, isn't this what banks do? Oh, the bank's not doing it, must be a problem. Is he really going to sell it? Do your documents work? What's the track record? All that sort of stuff. Kind of fast forward a decade, right? Businesses like all of ours, including many others, have done thousands and thousands of loans, billions of dollars of volume, and this track record to point to, not just in benign lending environments as we saw for the first 7 or 8 years since we started, but more recently, with COVID, with the rate rises and what's come after that in adverse lending climates as well. So I think with an investor hat on, you can actually look at a business, and there'd be many to choose from today, and you don't have to pick one. There's a range of options. So you've got track record, and also in absolute terms, returns are higher because the whole rate bracket sits higher than it did, 2 to 2.5 years ago. So I think in absolute terms, I think you can get certainly what we do, and I guess the other guys as well, you can get a secured return, so a return secured by hard assets with, you know, high single-digit, low double-digit return against something also really important that you can understand. I think, you know, part of the reason we love what we do, both for our own capital and for our partners' capital, is we actually understand it. And like, there's not too many conceptual leaps of faith in terms of kind of where the money is and how you get the money back. So I think for all those reasons, I think it feels to me like a golden period for investors. You know, albeit we're in a period of, as we touched on at the start of the conversation, of a little bit of uncertainty because rates have risen. I think the economy is going to start to get a bit tougher. But certainly in terms of what the asset class is and how investors access it, there's many access points, right, through Tom's point around the, you know, the private wealth businesses and, you know, the bank platforms and the products and various ways you can actually access the asset class. So, so I think lots of opportunity for investors.
Tom, anything to add?
Look, I agree with what Nick said. I guess, you know, what we see, you know, we always talk about we don't want to replace your equities portfolio. If you're trading on the stock market and trying to make very high returns, that's not the capital that we're trying to access. You know, we're providing stable, defensive, safe returns based on, you know, an underlying or underpinning security that's well understood with a very deep marketplace. And, you know, you're not really investing in the types of businesses we have through multiple economic cycles. The turnaround time on those loans is pretty well understood and allows for the duration risk to be quite good. So, you know, I think the risk-adjusted return with earning, you know, 500-600 points over where the risk-free rate is, that's a really good proposition for investors. And as Nick says, you know, if you look at the professional managers that are the wealth advisors, the financial planners, the funds managers, they're deploying their clients' products into it because they believe in it, and the space has continued to grow. And now, as he says, you can point to the number of exits you've had, the amount of capital you've had, and that you can do it through good times and bad times, and that provides safety. So, yeah, I guess that's what I have to add.
Definitely. Andrew?
Yeah, look, I think all I can really add now is probably the liquidity nature of it. So, you know, one of the key things I would say for most people when considering, you know, credit as an investment is what type of liquidity do they need? You know, if you're after a single asset deal, your liquidity factor is probably going to be pretty low. If you're in a pooled trust or a pooled fund, you've probably got a bit more liquidity. If you're in a very big fund or a very big pool, you've probably got access to more liquidity. So, you know, there's trade-offs there. It's not just about return, it's not just about security, but it's also about liquidity and what you need for your portfolio as an individual. I think that sometimes can be overlooked. And, you know, we hear stories of investors who, you know, come to invest in us because we have a pooled vehicle, we have multiple liquidity off-ramps, opportunity sets for liquidity on, you know, monthly, quarterly basis, depending upon which fund you sit in. But these guys have come with, you know, horror stories of, hey, I invested in, you know, a single contributory loan. It was 12 months, it's now 18 months or 2 years, and I haven't got my money back, I haven't been getting interest, I need to redeploy that capital, or I've got a big expense and I can't really make that capital, I can't use that capital, I can't exit that investment. So I think looking at the structure is just as important as looking at the underlying security and headline return.
Thank you. And I might do another around the room question. We have spoken a little bit about the interest rates, changes, inflation, that sort of thing, global economic trends and what we expect in Australia. But that has been obviously troubling investors out there. You know, we saw at the start of August the equity markets sort of crash a little bit, and there's uncertainty. Obviously, volatility is great. What sort of implications does this have on the credit market? Because I imagine that investors out there are a little bit concerned as we sort of head into, you know, the Fed's expected to cut rates, Australia's not yet, you know, maybe next year. Obviously expecting some, like you all mentioned, concerning economic data towards the end of the year. What sort of implications does that have on the credit market, maybe starting with you?
So I think Tom's point is correct. You know, we're not here to replace an equities portfolio. You know, if that's where an investor wants to be, or if that's a component of their balanced portfolio, we're not here to try and replace that. We wrote a piece on this a little while ago, which I might mention, and it discussed the idea of investors climbing a wall of worry in relation to equities. So it's kind of like, do I stay or do I go? You know, it kind of feels like valuations are getting higher and higher and higher, and the market's rising. But it's, with every incremental rise, it's susceptible to a bigger fall. So you don't want to miss out on the rise, but you don't want to suffer the fall. So kind of what do you do? And I think the point we've made that investors in our asset class are less concerned about that, because inherent in what we do, you have what we call the equity headroom. So, and coming back to the barbecue, which I've mentioned about 10 times today, if someone is borrowing 400 grand against a property worth $1 million, we would describe the headroom there, Maya, as $600,000. So the property has to fall by $600,000 or 60% before the investor starts to lose or impair $1 of their capital. And as I say to investors, we don't have a crystal ball, and the property market doesn't move completely in tandem. But in broad terms, if the equity market is halved, you've got to know that if the property market is halved, you've got to know that your equity market is in pretty bad shape, and unemployment's gone to 20%, et cetera, et cetera.
Sure.
So, we'll still be saying we got the asset, we're going to sell, it's going to be tough, we're gutsing through, stick with us. But your BHP is going to be in bad shape, and your micro caps and all that, it's going to be pretty messy on the streets. So, I think to sum it up, I think that the inherent headroom in investing in first mortgage deals and funds with first mortgage deals provides you that buffer. Obviously, your upside is capped, so you're only ever going to make the return of 400 or 500 points over. You're not going to double or triple your money in a year, but you're unlikely to lose big chunks of your money in a big downturn.
Good to know.
Yeah, I agree. Capital preservation is one of the features of the product class. I also agree that the where the LVRs are set and the sensitization work that's done to see what would happen if values were up or down protects it again and makes it defensive. I think from the investor landscape, you spoke about global or economic trends. I mean, none of us are economists, so I'm not going to try and speak on their behalves, but the Australian property market doesn't tend to have the high correlation to the global marketplace. So interest rates, population drive that far more. Inflation, that's where the most correlation exists. And we spoke about earlier the tailwinds that exist there. So I think in respect of comfort for investors, we have this huge supply-demand imbalance across our real estate marketplace. We have growing population base, and those are fundamentally things that will help to protect it. Starts are down, access to credit is harder, so completions are down. All of those things, which probably have more of an impact into the commercial real estate market, are quite favourable dynamics for the types of investments that we're providing and the safety factors. The global piece that maybe people have to consider is that we, would have the conversation on is if you've got currency exposure, but that's a completely different conversation and component.
Yeah.
I think, look, all I'd add to that is, I think the RBA's probably got a pretty tough rap in terms of how they've handled this. I think they've done a pretty good job. If you look at global peers, we're not looking at major cuts. We haven't gone as hard. And, Australia's a pretty stable economy. We're not like a boom or bust economy that the US is, so we don't have those same cycles. So I think from our perspective, we see still a very good, strong position in Australian real estate. It's a position that's now embedded that, it's a major pillar of the Australian economy. So it would be a pretty catastrophic event for a government to allow it to have a substantial drop.
Yeah.
So we don't see that. We see the benefits of real estate debt investment in someone's portfolio as providing that sleep easy at night aspect. You don't have the volatility in your price, you don't have the volatility in your capital, as Nick and Tom have pointed out. So your ability to open up your portfolio in the morning and you haven't seen a 20% drop or a 20% increase, certainly has value for investors, because we've spoken a lot today about certainty, and it just gives you a little bit more certainty in what is substantially still a pretty uncertain time.
And I've got a question from the audience here. I might go to that. I'm not sure who wants to take this one, so put your hand up if you'd like to have a go. But around sort of the regulation side, and we did mention ASIC a little bit earlier, and obviously they've announced recently that they're going to look at private markets more sort of closely, including, I guess, cred, and that is going to be sort of a strategic priority for them moving forward. So this audience member's asking, what's your take on concerns around transparency in this market? Who wants to start, Andrew?
I'm happy to. I think it's a great thing to have more transparency. I think I'm sure Tom and Nick are going to confirm this, but the major topic for us at the moment is what are your arrears, where are your fees, and what do you get paid that you don't disclose through your PDS, et cetera, et cetera. So I think it's certainly the topic of the day. There seems to be a new story about it in the AFR every single day. So I think that transparency would be a fantastic thing. You've seen, you've got certain disclosure regulations in Australia if you're a hedge fund, but if you're a debt fund, you don't have those same regulations of disclosure. I think the ability to be able to weed out good managers versus bad managers, a level of transparency and standardised reporting would be fantastic for the industry, and probably be very beneficial for most investors. So our view and our house view is we're well supportive of ASIC and their endeavour to show some transparency in the industry.
Yeah, look, I think that all of our businesses will stand up. I think that at times other sectors of the industry maybe have a louder voice in the media and want to talk their own book slightly. So, if you look at the compliance measures that we all implement, and I'm sure it's very similar across the businesses, when we have external auditors that are quarterly auditing every one of our funds that are auditing our book, we have external credit and investment committees with oversight from parties not in the business. We have regulation from our AFSL that allows us to write a 30-year bank grade mortgage if we want to. So APRA already has done a deep dive across us. We use independent consultants to oversee our loans. So we've got quantity surveyors, we've got third-party valuers. In our IMs for investors, they're disclosed exactly how we make our fees. In our deal-specific IMs, they see exactly what the pass-through is between the loan manager and what the borrower gets to the investor and what they receive. So I think at times, maybe people with a louder voice come out and talk their own book against what's the new burgeoning place. But if you look at the rigmarole with which we operate and the rigorous nature of the compliance measures which we all undertake, I think we'll be completely fine. And I think if the regulator comes in, they'll come to the same conclusion.
Yeah, listen, I think I would broadly agree. I think Andrew made the point, we encourage regulation, obviously to a sensible, not extreme level, because I think the smaller players are not resourced to handle it, so I think it becomes a point of differentiation. And I also think that kind of sensibly applied or interpreted, it forces you to raise the standard of your business. Like we report to APRA every month, similar to the guys, we do an AUSTRAC report every year on, we KYCing our borrowers and our investors. Obviously ASIC's there too, where we're Big Four audited. And so we like all of that because we think it forces us to operate at a certain level, but also becomes a point of differentiation in talking both to borrowers and to investors. So we encourage it. I sometimes say, a bit flippantly that, in certain products that we offer, if you have a little bit of capital, a set of loan documents from your brother-in-law and some ambition, you're a competitor of ours. And we've been going for a decade gutting away with 60 people. So kind of that feels a bit unfair. But then I kind of think back, well, if everyone has to operate to a certain standard, then hopefully you get to distinguish yourself on the business that I guess you've worked hard to try and establish. So but I think there's the balance there. I think that excessive regulation and Australia, I guess globally, it's somewhat notorious for its love of regulation. I think that's what creates the best and the worst, or the worst and the best of Australia. Is it's love of regulation. And I think the success of this space has been, its ability to somewhat flourish without excessive regulation. But when regulation comes, and as and when it comes, I think you have to deal with it as it comes and try and make it your friend. We have the same sorts of committees that the other guys have, and we often think to ourselves, if ASIC were to come in and wanted to have a look, what would they be looking for? How would we explain what we do? How do we assess the risks? Where do we actually focus our efforts? So, for example, we take wholesale investors. We're absolutely meticulous about making sure that nobody gets through the gate and gives us $1 unless they are qualified as a wholesale investor. So that's kind of a key focus of us, just in that part of the business. So, we'd be saying to the regulator, here's our processes, but here's the way we think about it. And, we might not tick absolutely every single box because the regulator will always find something. That's what they do. But by and large, I think we have the right approach. Yeah,
definitely. And we have run out of time. I might just ask you just quick one-sentence answers. Just your outlook, I guess, for the market over the next 5 to 10 years. What do you expect? So just quick answers. We might start with Nick.
Yeah, I think optimistic. As I said at the start, I think that the space will continue to grow, and I think if you can be competitive and relevant in the space, there's a huge opportunity for players like all of our businesses.
I agree. I expect continued growth.
Nice and short.
Permanent shift.
Yeah.
Permanent shift.
Definitely. Okay. Well, thank you all so much for joining me today on this webcast.
Thank you.
Thank you. Thanks, man.
And thank you to our audience for tuning in. We do hope you enjoyed today's webcast, and you can go back and re-watch it if you did miss the start, just on the webcast link on Investor Daily. Thanks again, and I'll catch you again next time.